Hello, and welcome back to my channel, The Midlands Investor, your one-stop shop for all things investing and personal finance. Investing for Growth by Terry Smith is a comprehensive guide to growth investing, providing practical advice and clear examples for investors seeking to build a successful growth portfolio. Terry Smith is a renowned investment manager with over 30 years of experience in the financial industry. He's the founder and chief exec of Fundsmith LLP, a boutique asset management firm that manages over $24 billion in assets. Smith has a reputation for taking a long-term approach to investing and focusing on quality companies with a sustainable competitive advantage. In Investing for Growth, Smith emphasises the importance of quality, diversification, and risk management in growth investing. He argues that investors can generate significant returns over time by investing in high-quality companies with strong fundamentals and holding these stock throughout market fluctuations. This video will provide a detailed analysis of the key concepts of investing for growth, with a focus on the main body of the book. The first key concept that Smith emphasises in investing for growth is quality. Smith argues that investors should focus on high-quality companies with sustainable competitive advantages when building a growth portfolio. He notes that these companies tend to generate strong returns over time and are more likely to weather market downturns. One key metric that Smith uses to evaluate quality is return on capital employed. Return on capital employed measures the amount of capital a company generates from its operations relative to the amount of capital it has invested in those operations. Smith argues that companies with a high ROCE tend to be high-quality companies with strong fundamentals. He also goes on to emphasise the importance of analysing a company's management team when evaluating quality. He notes that a strong management team can help drive long-term growth and navigate market fluctuations. He recommends looking for companies with a clear and transparent management team that has a track record of delivering strong results. Key concept number 2, diversification. The second key concept that Smith emphasises in investing for growth is diversification. Smith argues that diversification is essential for mitigating the risks associated with growth investing. He notes that growth stocks can be more volatile than value stocks and that diversification can help balance risk and reward. He recommends diversifying a growth portfolio across multiple sectors, industries, and geographies. He notes that this can help mitigate the risk associated with any one sector or industry experiencing a downturn for whatever reason. Smith also recommends investing in a mix of large cap and small cap stocks to balance risk and reward. Takeaway number 3, risk management. The third key concept that Smith emphasises is risk management. Smith notes that growth investing can be seen as risky and that investors should take steps to mitigate potential losses. He recommends using risk management tools such as options to limit potential losses. One option strategy that Smith recommends is protective puts. A protective put involves buying a put option on a stock to protect against a potential market downturn. If the market does decline, the put option provides a payout that can offset the losses in the stock. He also recommends using covered calls to generate income and limit potential losses. A covered call involves selling a call option on a stock that an investor already owns. If the stock price remains stable or declines, the investor keeps the premium from selling the call option. If the stock price rises, the investor can sell the stock at the higher price, but will have to deliver the stock to the buyer of the call option. Takeaway number 4, discipline and patience. The fourth key concept that Smith emphasises is discipline and patience. Smith notes that investing for growth requires a long-term perspective and a willingness to hold stocks through market fluctuations. He argues that investors should resist the temptation to sell during downturns and focus on the long-term potential of their investments. He recommends developing a clear investment strategy and sticking to it over time. He notes that this can help investors avoid making emotional decisions based upon short-term market fluctuations. He goes on to also recommend focusing on companies with a long-term track record of growth and a sustainable competitive advantage, rather than chasing short-term trends. To illustrate the importance of discipline and patience, Smith provides several examples of successful growth investors who have achieved significant returns by holding on to their investments over time. He notes that these investors have the discipline to stick to their strategy, even during market downturns, and are rewarded for their patience with significant long-term returns. Now, moving forward, let's take a look at a case study on Amazon. To provide a concrete example of the principles outlined so far, let's look at the case of Amazon. Amazon is a high-quality growth stock that has generated significant returns for investors over time. Let's examine how Amazon stacks up against Smith's key concepts of quality, diversification, and risk management. So firstly, let's look at quality. Amazon is a high-quality company with a sustainable competitive advantage. The company dominates the e-commerce market and has expanded into other areas such as cloud computing and digital streaming. Amazon has a high return on capital employed and a strong management team led by founder Jeff Bezos. Diversification. Amazon has diversified its business across multiple industries and geographies, in addition to its e-commerce business. Amazon has a growing presence in cloud computing, digital streaming, and brick-and-mortar retail. The company also has a global footprint, with operations in North America, Europe, Asia, and Australia. Risk management. Amazon has used various risk management strategies to mitigate potential losses. For example, the company has invested heavily in logistics infrastructure to improve delivery times and reduce shipping costs. Amazon has also used option strategies such as protective puts to limit their potential losses. And lastly, discipline and patience. Amazon's success can be attributed in part to the company's long-term perspective and discipline. Despite facing significant challenges over the years, such as the dot-com bust and the 2008 financial crisis, Amazon has stayed true to its core strategy of investing in growth and innovation. This long-term focus has paid off, with Amazon's stock price increasing over 100,000% since its IPO in 1997. So, in conclusion, Investing for Growth by Terry Smith is a comprehensive guide to growth investing, providing practical advice and clear examples for investors seeking to build a successful growth portfolio. Smith emphasizes the importance of quality, diversification, and risk management in growth investing, as well as the importance of discipline and patience. Investors can use Smith's principles to evaluate potential growth stocks and build a diversified portfolio that can generate significant returns over time. By focusing on high-quality companies with strong fundamentals and a sustainable competitive advantage, and using risk management strategies to mitigate potential losses, investors can navigate the risks associated with growth investing and achieve long-term success. While investing for growth requires discipline and patience, the potential rewards can be significant. By staying true to a clear investment strategy and focusing on the long-term potential of their investments, investors can achieve significant returns and build a successful growth portfolio. And once again, that's it. Thank you for watching. I've been the Midlands Investor. Don't forget to like and subscribe if you enjoyed this content, and I'll see you again next time.